Now, let's review the solution to this problem. In this problem, they first ask you to make the entry to record the purchase of the land and the building described in this problem. And again, you have a building, including land, where that building sits that is purchased on July 1st of X2 for a total of $400,000. They figure that about 10% of that price is paid in cash, and so $40,000 is actually paid with a cash down payment, and the remainder is paid through the execution of a mortgage note payable. This mortgage note bears an 8% fixed interest rate. Now, it doesn't say annual interest rate, but we'll assume that because we've said that you'll just assume it's an annual interest rate unless stated otherwise. And this interest rate compounds monthly for 30 years and is fully amortizing over that 30 years with monthly payments of $2,641.55. That's due on the first of each month after the date of purchase. The first question is, what would be the original entry to record the purchase of this real estate? Well, they asked you to assume that the land is valued at about 20% of the total price. The total price was $400,000, so we'll debit land for $80,000. Debit building for the remaining $320,000, $400,000 total, credit cash for $40,000, and credit mortgage note payable for the remaining $360,000. The next question is this: why do you think the allocation of the purchase price between the land and the building would be important for financial reporting and income tax purposes? The answer is that the land is not depreciable. The greater the allocation of this cost to the building, which is depreciable, the higher the depreciation expense reflected on the financial statements, and therefore the lower the resulting net income for financial reporting purposes. This would also result in lower income taxes. But again, you've kind of got a compromise here. You're always interested in paying lower income taxes, but you really want to have a higher net income to impress your investors. And in this particular case, the IRS is going to be very sensitive and expect you to make the same allocation to land and building for financial reporting purposes as you're using for income tax purposes. And so you really can't use a different amount of allocation for one versus the other unless you have some explanation. I can't think of one offhand why you'd do it, at least from a business standpoint. And so the question here is do I want to show less income and as a result have less income taxes, or do I want to allocate more to land and therefore have less depreciation and higher net income? And that's a tough decision that needs to be made. From the CPA standpoint, who may be auditing the financial statements, they simply will want to make sure that whatever the allocation is, that it makes sense, that it's consistent with real estate in the area in terms of the value of land versus buildings. Now, the next part of this problem asks you to prepare the entries on August the 1st and September the 1st to record the monthly mortgage payments on those dates. Well, let's do that. The entry will have a credit to cash in both cases for $2,641.55. That was given to you. That's the monthly payment. The question is, how much of that represents interest and how much of that is then to be applied as a payment of principal on the note? Well, the amount of interest is always calculated first, because with any payment, it is first accounted for as payoff of any interest due, and any excess is applied to the mortgage note payable. So let's calculate the interest due at this point in time, and the original principal balance starting this first month of ownership of the real estate is $360,000 times 8%, the annual interest rate, for 1 month or 1/12 of a year, or $2,400. The amount of the payment that's in excess of this, $241.55, represents a partial payoff of the principal of the note and will debit mortgage note payable. In the following month, again, the entry looks very similar. The numbers are a little different, although the credit to cash is the same, $2,641.55, as it will be with every payment. The only difference here is the amount of interest expense and the allocation of the excess to the mortgage note payable. And again, we'll calculate the interest first. The calculation of interest here is complicated by the fact that the principal amount is no longer $360,000 as a result of the portion of payoff with the first payment. So at this point in time, the outstanding balance of the mortgage note is $359,000, $359,758.45. Wow, this is getting long, isn't it? These numbers here, times 8% for 1 month, or $2,398.39. The difference is applied to payoff of the mortgage note for $243.16. The next question in this problem asks you to determine the balance of the mortgage note after immediately following this second payment. Well, just draw a T account and show the declining balance of the mortgage note by beginning it with a credit balance of $360 and then showing the amounts of each of the debits from the first two entries. And it leaves you with $359,515.29. In fact, if you're going to pay off the note at this time, that's the amount that you would owe. You don't owe the full $360,000 anymore. Now, here's an interesting question. What would be the effect if monthly payments in excess of $2,641.55 were periodically made? I mean, I've heard some people say, hey, listen, sometimes I like to pay twice the payment, or pay it, pay that amount every 15 days rather than every month or something like that. Well, what is the effect of that? The effect of that is that the term of the note would be shortened. To the extent that we are applying more payment, first we pay our interest. Then to the extent that we pay any more than the amount of interest, it's applied to principal. And as we pay off more of the principal, then in fact, we'll pay off the total amount of principal before the 30-year period. And so the effect of that, in most mortgages, they will provide that if in fact you make more of a payment, it does not reduce your payments in the future. You'll still have to pay the $2,641.55 every month, but you simply won't pay it for 360 months if you make additional payoffs along the way.